Hey guys, welcome back to week 4 of the investment journey. As we continue investing on a weekly basis, we're going to look at the results in today's video. And overall, the stock market has been doing incredibly well. When you look at investment portfolios, if you're looking at your IRAs, your 401ks, the stock market has been on fire. The remaining or the kind of the later part of 2023, putting $1,000 in here does make a big difference. And I really wanted to cover the dollar cost averaging as well as what we're doing within the portfolio itself. So what we're doing is every single week we're investing $1,000 into the Monday morning buys. Now, doing research, they said Monday morning is always the best time to invest in the market, which means as soon as it opens up at 9:30, we are doing our purchase every single week and really stockpiling the portfolio that we're building in here, which is incredible. Let's go ahead and take a look at it. So here we do have it through M1 Finance. As you can see, this is our debt-free journey, guys. This is ultimately what we're going to use, not an inclusion of 401ks, IRA money, everything else. This is just a taxable brokerage account that I've been putting money into on a consistent basis. As you can see here, we've been running just a little over 2 years in here, but look at the gains that we have seen. Now, even looking and thinking of 2022, that was a very big down year. We're talking 20+% that we were down on the entire year. Makes a big difference when your dollar cost averaging in. So literally, when most people get into the stock market and the stock market continues to increase, they are going to continue buying and buying and buying until it continues to increase. At a point, they're going to hit a point where they're buying and the market is going up, which is really counterintuitive, guys, because when you're purchasing, you're paying more every single time that the market is going up. As soon as you see a dip or as soon as you see a drop in the market, that is the point when you should start buying on a regular basis. Even if it continues to decline, you have to really detach the emotional aspect that you have with investing to the logical side. When you think of things, if you're going to buy a new car and all of a sudden it's 5% more, you're probably going to be hesitant, wondering why the cost of the car has went up. However, if the car is 5% less, you're going to be very inclined to buy it because now it is discounted, now it is at a cheaper price, which is the same way to really look at your journey with the investment of the stock market. And again, when you look at the automatic investing for the 401ks, things of that nature, guys, it is really imperative that you're putting money into it. And the more that you can actually put into the account is going to make a big difference. So looking right here, guys, over the past 2 years, we've gained $8,000 or 34.29%. Now we know this year we're up probably about 15 to 18%, but when you couple the dollar cost averaging of what we bought in 2022, that is the reason why we are seeing almost a 35% return. Now with this, guys, the market gains, we're at about 7,259. And then of course you can see the dividends right there, which do make up the total amount. Now for 2022, I was only investing in one specific ETF. If you know, and if you follow some of my videos, I only look and I only invest in ETFs that really spreads the risk. I know a lot of people do mutual funds. I do not choose to do the mutual funds because most of them do come with a higher cost, but we are still putting money into the regular portfolio that you see right down here. So again, the VOO or the Vanguard S&P 500 is where we have almost 70 in there right now, guys, making up 92.8% of the portfolio. Now, when we started this, we were at 100% of the VOO. As we continue to put money in here, you can see it actually queued us for 3 buys. It will not put anything into that VOO because it is overweight. Essentially, the way that they look at it with M1 Finance is because I do have 92% in the VOO and I want to keep 25%, it will automatically rebalance over time through purchases that we're doing within the stock portfolio. So it's a little different way to do it, but essentially this will get to 25% eventually as we continue putting more money into all of these. Now, if you remember, guys, when we started this, these were all at 0. As we continue making contributions, they're almost to 2.5%. But now the actual target or that 2.4% here versus the 2.3%, that is because some of these funds have outperformed other funds. That is the reason why we're seeing a little bit of a variation. When it comes to the auto or the rebalancing, their system actually does it automatically based on money that you put in here. So I could rebalance, but that would mean selling out the VOO if I rebalance to that 25%. And if I did that, it can create a taxable event. So you do have to be careful with that, because selling them, especially when we've had a significant gain, as you can see right here, guys, the VOO, we're about 8,000 up right there. And then the SCHD is 2,300, the VUGs at 15, and the QQQM, which I do advise going into versus the QQQ, is up 87. So we've seen some pretty decent gains and some good returns. Now, I have not held these since we started this portfolio. That's why some of the percentages are a little bit off in here that you're seeing, is because we have bought and sold over the last 2 years, changing a couple options in there and figuring out exactly the portfolio that we wanted, which is the one we have right here, guys. This is the portfolio that we're staying with for an incredible amount of time. I want to just really hold on to these forever. That is the intent. When you look at the history of some of these, even going deeper in the VOO, when you start looking at the VOO details and going back, the 5 year, you're looking at a 66% return on the 5 year, which is incredible, especially if you're putting more into that. And then, of course, if you go back and you look through all of these, the last 5 years, even looking at COVID, looking at everything else, even like the VUG, majority of these have a very, very low expense ratio, which again is the reason why I do the ETFs. But if you look at the details again, looking at the 5 years, you're at 103% over the last 5 years. Now, for me personally, have about another 6 years to retirement at the age of 50. But if we're looking to retire early, we really have to stock this up a ton, as well as negating all of the debt. So literally eliminating all of the debt that we have, meaning this portfolio has to go up a ton, 40 to 50,000 a year for the next couple of years. And then, of course, not really retirement as it is per se, but looking at different options and seeing what else we can do differently. But I am excited, guys, as we continue here. So we're going to buy another $1,000 when it comes to tomorrow on the investment portfolio on the Monday morning. Let's go ahead and update this to 0. So it will put our full buy in there. Now let's look at the Excel spreadsheet, guys, and see exactly where we are. So again, a month ago, and it is almost right to the month. So we started this on the 13th, or essentially the 12th. We were at a 22% return over the last couple of weeks. 29% was on the 20th. 27th, we were at 31.98. And now on the 4th, which today is the 3rd, but tomorrow will be the market day, 34.29. Now, overall, as much as I like to see the numbers go up, and it is really exciting, going from a 69 to a 74 in the portfolio, I like buying when it goes down, guys. This cannot happen perpetually. This is not going to happen forever, because essentially we do want the dips. We do want the fluctuations in the market, because that will trigger and really focus on the overall dollar cost averaging effects that we're looking to get out of this portfolio. Now, of course, because we are in December at the end of the quarter, we're going to see some definite movement in the dividends, guys. All 4 of those ETFs that we do hold are going to pay dividends within the next month. Most of them, I think all of them do pay quarterly dividends. So we're going to start getting a lot more dividends. In addition to the growth aspect that we're seeing, the dividends are going to be on there. And then this balance difference, I just have this week over week, guys. So from week 1 to 2, we made about 1,600. From week 2 to 3, we made 17. And then, of course, from week 3 to 4, which is where we are right now, 16, 17. So actually last week was a little bit bigger of a gain, but as we continue building the portfolio, and then I do what the value is, not the percentage wise, but what the value is of the portfolio and what it actually increased between all 4 of these guys. And again, the stock market has been on fire since we've been investing. And as you can see, guys, right here's the proof. Now, what I'm thinking is doing this for at least a year. So if we can get to 1113 of 24 with the deposit or the interest, putting another $1,000 in there for the next essentially 48 weeks would build up a huge portfolio fast. Now, of course, with the snowball, guys, with the dividend snowball, with the compounding interest that we see in here, and everything that we get is going right back into the portfolio. It's going to exponentially grow as we continue this further and further, because then you can kind of map out, 3 years, 5 years, 10 years, 20 years down the road with the portfolio, with consistent contributions to here. But all right, guys, so that'll do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.